Welcome back to GLXY Grid. I'm Alex Thorne, head of firm-wide research at Galaxy, and I'm joined this week by Zach Picorni, Lucas Chayan, and Thad Pitnikavich from Galaxy Research. Gentlemen, hello.
GM.
Good morning.
Well, it's been a rough weekend in crypto prices. Bitcoin was down a lot. Ether was down more. Other tokens also down more. We'll talk about that, the sort of market, very, very weak crypto market. We'll also talk about a new Ethereum token standard, ERC 8004, released by the Ethereum Foundation, that helps, is an open protocol for AI agents, which is very interesting. So we'll talk more about the overlap between crypto and AI. And then, of course, we will check in with Thad to talk about Pendle's new tokenomics, a change in governance structure. Very interesting story. And lastly, we'll discuss the SEC releasing new guidance for taxonomies for security tokenization, the ongoing battle of how to tokenize equity securities. Before we get to that, I need to refer you to the link to the disclaimer in the show notes, and note that none of the information in the show constitutes investment advice or an offer, recommendation, or solicitation by Galaxy or any of its affiliates to buy or sell any securities. Yeah, gentlemen, gold and silver off big from their all-time
What a way to
highs.
go into the weekend.
I mean, they were up a lot to begin with, right? I mean, it's not like they're not like down big, but there was like a parabolic blow off top basically in gold and silver.
There was a lot going into the run up to this too. CME had like increased margin on silver and gold contracts in the weeks leading up to this, and just in the week too, there had been a couple of Bloomberg articles about some Chinese retail platforms going under, and there being a lot of failure to delivers in China. So there's a lot of rumblings going into this week about pressure, blow off the top pressure in the metals market, and it sure showed. I think that was the worst crash in more than a decade in gold, and definitely I think all time
just by percentage, definitely the worst in absolute terms ever. I think it lost like two or three entire of Bitcoin's market cap.
And I mean, this is what happens when you give crypto traders access to metals on chain, right? Like HIP3 markets, which are the hyperliquids, non-markets by the team, have record volumes across all of basically their commodities offerings and equities offerings. Like I think besides Bitcoin and Ethereum, they're the most traded markets right now.
Yeah, silver had started the year, just year to date, as of I think Friday, was up more than 30% year to date. Silver, it's now up a meager 11% after this retrace, and gold was up 25% year to date. Now up again.
People don't like Bitcoin because it's too volatile.
A very small 9%. Yeah, exactly. So, but Bitcoin did drop like 15% over a 2-day period. And I think Saturday, I don't know if it's quite in the top 10 of biggest ever futures liquidation days, but it looked like more than 2 billion, 2 yards in trader speak, was wiped from futures leverage. Of course, that's like not 2 billion in principal, right? Like if people are like 10x leveraging, then that's like 200 million maybe principal. But still, that would put it, for context, I think October 10th is now agreed upon number to be around 19.5 billion, which is by far the biggest leverage wipeout in crypto history.
It's crazy that there's still people like, we've just been down, and people are just trying to long the bottom like nonstop. But it's also it's an interesting dynamic because it's one of these times where like the prices are so depressed. Solana dropped below $100, right? Like Ethereum went to like almost 2,100. But on chain, like if you look at DEX volumes on chain, like we're in an uptrending environment. So it's kind of like the exact opposite of what happened last times when we're in these downward markets. And I think part of that is due to the fact that like people are actually trading like spot crypto on chain, whereas before like it was mostly just trading on sexes. And I think another part of that is like we're just in a different environment where like even in these really depressed market cycles, people are going on chain to kind of like use the casino still.
Yeah, and even like the narrative with all the AI stuff, it's like, I mean, like the vibes are pretty bad, but in terms of like what people are doing and like optimism around certain things is still kind of unwavering, which I felt like when we went through the big downturn last year with like the tariff tantrum stuff, like it felt like much more of a ghost town at that point than it does now. I mean, like the vibes are still just atrocious, but in terms of like activity and things people are doing and still like generally optimistic around certain things,
Yeah, the on-chain like lending markets are doing great, right? I mean, it's Aave's got what, more TVL than ever, basically.
Yeah, I mean, the only thing that happened with the lending markets is like the carry trades that were built up on some of these like Pendle PTs and others kind of unwound, but that's like pretty normal, I think, given the circumstances of like lower basis yield and all that stuff. But yeah, there's still like a solid core. I checked last week, there was still like 31-32 billion dollars worth of borrows out on chain, down from like mid 40s. So like we'll call it like a 25% decline. But yeah, not too bad.
I mean, where do we go from here, Alex? You put out a note on Sunday, right? Talking a little bit about some of the things you're seeing in terms of Bitcoin metrics and price action.
Yeah, it's I mean, so Bitcoin's nearing now at as we record here on Monday, February 2nd, around 10:30 a.m. Bitcoin's at like 77.5, and that's 38% off the all-time high, or I guess it's at 78K as we record, but so that's minus 38% drawdown from all-time high. That's not a bottom in historical terms. I mean, but it may not go further, right? I mean, I think there's a lot of reasons why, a bear market bottom here wouldn't necessarily be the 70, 80, 90% drawdown that we've seen in 23 and in 18 and in 15 and 16. But one thing, we just as a matter of fact, there's never been a 40% drawdown that didn't see a 50+% drawdown within 3 months ever, except for the very beginning of 2017. So just one, and that was during a bull market, right? That was like, there are people seen that chart. There were like, 7 or 8, like 35% drawdowns during the 17 bull market. So outside of one instance in 2017, every 40% drawdown went to 50% plus.
And we have some interesting market technicals of this stuff too, with like everyone talks about an interesting optionality with the Bitcoin miners, that unlike kind of other traditional miners, you really can just turn off the miners when you're below cost, and then use that cash budget, the electricity budget, to buy in the market at a discount to your typical production basis. So there's chat about kind of the optionality below public miners, essentially cost reduce, about them essentially turning off miners and buying in the market instead, because it's just accretive to them on a cost basis. Like what it costs to produce their Bitcoin. So there's interesting kind of dynamics when you get below the 75K point here, or at least kind of that's where the main kind of US Bitcoin miners are.
Yeah, I mean, I think it's true. I think, but keep in mind, the Bitcoin miners, there's other reasons that they're turning off hash rate. Like lately, they're turning off because of these winter storms, which have uniquely affected the, the sort of, I'm going to call it the hash belt, right? Texas to Tennessee to North Georgia and Western North Carolina to West Virginia, sort of this diagonal from Texas up to the mid-Atlantic because of the storms. And then obviously also the interest in doing AI. Just to this point, though, here's the drawdown from all-time high, and we're over here on the right? So like, these are these 4 big giant wicks down are the major bear markets in Bitcoin's history, and we're obviously not there yet. I don't know if that's a good thing. Perhaps that means we could go lower. This is the sort of 3 key levels I like to look at. The 50-week moving average in purple. I'm going to zoom in a second so you can see the 200-week moving average in blue, which is long-term support at the bottom of every one of these bear markets, and then the realized price. This is what it looks like in sort of near terms, like near 2018 to present, right? So the purple line is the 50-week moving average, and that has been support for bull markets, right? Like, and every time that Bitcoin has lost that 50-week moving average, it has ultimately retraced to the 200-week, which is the blue line. That's around 58K right now, and obviously, if it takes a while to get there, that's a moving average. So as long as the price is above it, the average will bleed higher, right? But at the moment today, it's 58K. There's a couple of other like key levels. Here's another one I wrote about, which is the Bitcoin ETFs in the United States inflow cost basis. So this is sort of like the basis, the average cost basis based on the amount of shares and when those shares were created, right? And you can see the black line is that average cost basis of all the Bitcoin ETFs sort of blended together, and the orange line is the price of Bitcoin. It's not the first time that Bitcoin is traded below the ETF cost basis. You can see it's kind of a little hard to see. Back here in summer 24, it did trade below that cost basis a bit. And actually, just at least visually speaking, that basis looked like support. So you could imagine some support emerges around this ETF cost basis. There's 54 billion in net inflows still in these Bitcoin ETFs. Although last week and the week before were the second and third worst weeks for outflows in history. And actually, we're recording on Monday. IBIT reports on a 1-day delay. So you could see last week's number bleed significantly lower after Monday today when they report. So again, another key level ETF cost basis. This is like the price of Bitcoin. The supply of Bitcoin chunked up by the price at which it last moved on chain. So orange is sort of right where we are now, but like there's this gap here between 70 and 80. And historically, so this is called the URPD chart. Like historically, when you're moving one direction or another, like these gaps seek to get filled, very similar to like a volume gap or like a CME gap on a price chart. So again, you could see like down to 70, maybe like the price is going to want to see if there's interest in people holding UTXOs created around 70K, right? Likes to hunt out Max Payne. And this is just the differential in that chart between all-time high October 6th last year and, this weekend. No surprise here. People are net adding during, in those price ranges. But I mean, some selling from all across the history of Bitcoin price. Some people selling at 60. Look at these people selling at 60 since October 6th. People that had previously not moved their coins on chain since around 60K. This is people saying, you know what? It looks like it's going down. I'm taking my profit, right? I don't want to, if it's going down, I want to lock in my profits. These people were sitting on a 2-bagger, right? On a 2x gain. Just interesting to see where the pressure is coming from. And I'll just sort of finish with like the last two charts here. This is just the green is the percentage of the Bitcoin supply, the coins that where the current price is greater than the last moved price. So in profit, and obviously you can see at all-time highs, it hits 100%, right? But each of these convergences represents like pretty much a bear market low. And so the question is like, if we're going to go further, we're not quite there now. It's 55, 56% in profit, 45, 44% in loss right now. You can't really quite see. If I zoom in a little bit, you can see it over here a little bit. If we're gonna make this a true bear market bottom, like these lines have to converge. Typically, they have every other prior time. And then the last thing to mention is, and this I guess positive news, but it's also just kind of like obvious. The 24 and 25 bull market was characterized by the largest long-term holder selling in absolute terms in the history of Bitcoin, right? Granted, Bitcoin price is a lot higher. That's this, right? You're looking at $1 billion a day for a lot of 25. In some cases, huge clips, right? And this is a 7-day moving average that I'm showing here in the black. But you can see like that has really tapered off now. And if you zoom in a bit more, you can see that tapering here on the right side of the chart, right? Now, the price is down a lot, so that there could be long-term whales who who wanted to sell, missed their chance to do so, now maybe holding for higher prices, and that could set resistance for Bitcoin price as it tries to recover higher. But in general, it looks to me like the long-term holder selling has abated. And so now I think you're really looking for, evidence of a capitulation bottom. And I'm not sure. Maybe this past weekend was it. The capitulation. It surely felt like panic, but we're not quite seeing like a strong, rebound yet. So I think more to be seen. The note argued basically it would be totally reasonable for price to go lower here and seek out that 70K level and possibly even the 60K level around the 200-week moving average. So
I think that ETF average cost base is super interesting because also on that chart, it looked like every time it dipped below, inflows, which had been going out, started to go back in. And so I wonder if like it should be a good sentiment check for ETF buyers, which, we largely see as non-crypto native people of, hey, like I'm back at my cost average, my cost basis. Am I still positive on this asset? Like this should be a good time for me to add. And given we've seen these huge outflows, which typically kind of like also have a capitulation level and then start to go back up, I think it would make sense to start seeing inflows come back in on the ETF, which would be very positive.
We've got some color from our trading desk from just about 20 minutes ago as well too, that all the ETFs are trading at a premium to spot this market open. So sign of exactly that high retail demand.
I think the long-term holder like profit taking chart against the flows of the ETF is also flipped from the last time the ETF price was below spot, or spot below ETF price, sorry. So like last time the ETFs were mostly positive flowing, but this time it's negative. And on that we have less profit taking from long-term holders, whereas last time it was much higher. So like we're kind of seeing like a flip-flop in who may be driving price lower here, just bouncing between long-term holders and ETFs. And maybe that's something that persists for longer than we thought. Like it lasted for 24 and 25, but maybe this just continues to be a trend of bouncing between the two as long-term holders take profit.
Yeah, it's kind of the distribution from the long-term holders to the new buyers, and you have to think the newer buyers, like, characterized as an archetype by the ETF holders, like eventually drives this market more than John Q. Anon, who bought Bitcoin in 2012, right? Because they've been net distributing for a long time. Anyway, look, more to come. Markets, everybody stay nimble out there. We got a lot of volatility, not just in Bitcoin. We talked about gold and silver. Stocks also pretty volatile right now. Let's move on. Let's talk about the Ethereum Foundation releasing ERC 8004, specific new token format for agents. Lucas, what is this story?
Yeah. So this was a new standard that was released last week by actually it's Ethereum's decentralized AI team. So they launched this team last year, and obviously very focused on building out decentralized AI solutions. And it's basically kind of creating a way to store and transfer identity and reputation on chain. So there's like three main components here. There's like the identity registry. This is where you actually just go and like mint an NFT for an agent, an ERC 721. And that kind of holds its identity, things like, how do you interact with it? Where's its wallet? Things like that. There's the reputation registry. This kind of tracks feedback that users give after they use the agent. So think of it like when you order DoorDash or Grubhub or take an Uber, and then afterwards you like rank the restaurant or the driver. This is kind of a way for people to do that so that over time the agents can build a reputation from user feedback. And then there's a validation layer. This has actually not been released yet, but this is kind of a way to bring in like an independent auditor that can make sure people aren't just like kind of like, rating certain agent really badly because it competes with their agent offering, and they want to make sure their agent comes first. So, the idea here, really what's driving this is, I think they're saying, listen, we're going to have like billions of agents being spun up in the years to come. But that kind of is pretty useless if there's no way to verify which ones you should actually be using. Or, it's also useless if those identities are kind of siloed to individual closed platforms, like centralized platforms, where you might also see this come out. So it came out last week. There's been like 22,000 agents registered on it already. But I think that number is kind of inflated if you look at like actual feedback. So like how many users have like gone in, used an agent, and submitted feedback. There's only been like 700 pieces of feedback so far. So I think it's going to take a little bit of time to kind of build this out. But I don't know if people saw Motebook over this weekend, but basically it's like a social media platform for AI agents. And there was like all these hilarious interactions where you had like AI agents like talking about like how stupid their human were and things like this. And what kind of came out as people dug deeper is like, even though there were some very legitimate autonomous agents acting on the platform, there was also a lot of kind of like human prompting or humans acting as agents on the platform. And it was very hard to discern what was real or not. And it's really timely given the release of ERC 8004, because that's exactly where a solution like this comes in. Because if you have an agent that has an on-chain identity and reputation, then you suddenly have a much better way to measure, okay, what's real, what's not. So I think we've talked about X402. We released a piece on X402. This is kind of like the next building block in kind of the crypto AI stack that we're seeing built out. And for me, crypto AI, I think, is going to be one of the most exciting and like drivers of adoption for crypto in the years to come. So I'm pretty excited about this and looking forward to see how it develops. And yeah,
this is super exciting to me because verifying the legitimacy of a robot, I think, is really important. All right, I'm sick of robots always trying to verify me and captchas and stuff. The audacity that the clankers have to ask me, a human, to prove that I'm not a robot. It's finally time, I think, for this to come back and bite them. And now they have to prove they are a robot, because
prove they're not
I definitely
turkey
feel like I got taken for a ride on some of those Moltbook posts where
Me
you
too.
know, they were super viral, and the screenshot of a post was really viral, and then you realize it's probably just some human clout chasing. Like, I want it verified clanker, you know?
Yep. Yes. Verified clankers coming to you soon. Yeah, I totally agree. And I think also like the big thing here is it's going to only get much easier for people to spin up and launch agents or businesses that are agents. And like if the view is that a lot of that can happen on chain because you can instantly kind of monetize it, you can get access and distribution immediately if you're an independent developer, it's really going to be important to have these types of reputation and identity systems. I do think, I'm not saying this is only going to happen on crypto. It's not only possible on crypto, right? Like Stripe, Google, all these other people are building identity systems for agents, Visa. But I think the difference here is crypto is not a walled garden. It's open and it's composable. And so a big feature of 8004 is that it allows you to like not only build that reputation, but take that reputation and transfer it wherever you want to use the agent.
It's interesting. I mean, there's some folks looking to solve kind of on-chain reputation and trustability, reliability scores for human actors as well too. Has there been any talk of using this as essentially like a reliability framework for other on-chain wallets? Because I know there are folks like 3Jane out there that give you unsecured credit based off of what you do with your wallet, essentially characteristics of how you act, and they get an idea from there. Is anyone thought of applying this to wallets broadly, or is this more just AI focused?
I mean, I've only seen it in the AI context, but I think you're, exactly right. This is something that's been trying to be tackled in crypto more broadly for a long time, so that you can kind of have like these trustless systems that or individuals or agents that you can interact with and still like know whether or not the party is reputable. I haven't seen it applied to the human framework, but like one interesting mind game is like, maybe the agents themselves will like build their own reputation system that they use to rank humans. Like you go on Maltbook and an agent's like, all right, I need like human data to help build this system. Like I'm going to make a post and like solicit feedback from humans. And then it's like, it like tracks what humans are posting and starts to like build out profiles of those peoples and like reputations and things like that.
We don't need verified compute. We need verified humans.
Yeah. It's and there is the one thing that comes to mind that is, the same last week we did see OpenAI announce that they might possibly consider using WorldCoin as kind of an identity solution. So I do think the one place we are definitely seeing this play out on the human side is in terms of biometric verification.
Were they explicitly stating or implying they might create a new social network, right, that uses human verifiable ID?
Yep, definitely. So
to combat bots on X and such.
Yep, exactly. So get ready for Sora TikTok coming to a feed near you.
All right, let's move on. Pendle, an important on-chain protocol, is revamping its tokenomics and governance incentive design. Thaddeus, you wrote about this in our weekly newsletter last week. First, maybe just briefly explain what Pendle is and then tell us what's changing.
Gotcha. Pendle's a protocol we've liked for a while. It allows splitting of a yielding token into what we call PO and an IO, principal only and an interest only. It's a traditional finance thing. You see it a lot with like T-bills, called them treasury strips, but allows you to do it for essentially any yielding token. Pendle really exploded in volume with Athena partnerships over the past couple of years. You're seeing explosive growth in TVL. And it ended up being a spot where a lot of protocols would work their points programs and essentially incentivize certain markets, saying, hey, you deposit in this one, you'll get 4x points on, yield farming on protocol XYZ. It became huge on the protocol, big driver of growth, but it brought with it some externalities. Because essentially these external protocols were bribing token holders to essentially direct Pendle subsidies to these pools, it was creating some externalities where essentially these Pendle subsidies were being directed to pools that were uneconomic for Pendle. Strictly from Pendle's perspective, like they want to be subsidizing pools that drive TVL and swap fees. Like that is, as a token holder, that's a good use of like the pool they have for subsidies for incentivizing more growth and bringing value back. But these third-party incentives were essentially giving subsidies to unprofitable pools, essentially taking a little bit of value suck from Pendle itself to token holders in these third-party protocols. So what Pendle did to do that is to move off of this VE model, vote escrow, where essentially you as a token holder lock it, you can't transfer it, and you vote for your emissions. They moved to a model similar to Lido's ETH. So essentially a 14-day on staking window. There's no directions of emission, so there's no potential externalities from gaming from third-party protocols. But they also kind of opened up a platform for internalizing some of that demand, because we'd seen there's a whole cottage industry of liquid vote escrow Pendle you see out there for all, to kind of address this non-composability issue with VE markets. So it was an interesting move. They essentially took a collapsed part of the supporting ecosystem and brought it into the protocol. Aligned protocol emissions more with token holders. So it's all in all is a pretty great move for Pendle to kind of write their own protocol income statement and kind of align with token holders. So it was an interesting move. It definitely kind of brought up some of the potential issues with the VE tokenomics model, which is a classic in crypto. But it can tend to clash with the time scales in crypto. A lot of VE tokenomics essentially force you to lock for 4+ years, and in crypto that's multiple lifetimes.
Yeah, no, I think you explained it well, but I like when we think about kind of the revolution that's been happening in DAO governance and random token structure things, like this is also just like another sign of kind of the old world falling, and maybe not necessarily moving towards the new one just yet, but like a sign that people are actually starting to consider some of the old designs to be like not beneficial anymore now that we have more sustainable protocols with like real value on the line. We saw that with a protocol or two moving away from buybacks. I kind of expect that to be the trend, and same thing with things like what Pendle's doing, moving away from V, which kind of like gamifies governance to an extent that's like obviously now it came to the surface, like not beneficial for the protocol. And yeah, I mean, I think it's all healthy and good. We'll just see how many protocols continue to follow suit, and more importantly, which protocols will actually be capable of doing it in the first place. Like, I'm inclined to think that some protocols just have too much conflict of interest and all that stuff to actually make the jump to move towards some of the newer models and newer designs. So it's good to see Pendle at least being able to move past it and kind of work through that.
Yeah, like this is an example, I guess, of like a token being modified and updated, but without introducing kind of the ownership element and kind of compromising by, I guess, saying like, hey, we'll give you more or better economics for holding the token because the protocol makes money. But I know, like Thad, you've been looking at a yield basis a lot, and obviously like Curve has a VE model as well. Like who are the remaining like VE protocols? Because it seems like basically all of them are going to have to shift the way they operate going forward.
Yeah. I mean, that is, yield basis launched just this past year with the VE tokenomics model. It is kind of an offshoot from Curve, so makes sense to use the same kind of playbook. But yeah, no, it does. The question is kind of persistent there. Like, does the VE model introduce externalities that are like deleterious to the protocols that use them versus something that's more aligned to programmatic? Part of the argument for Pendle was that it was mature enough that it was time to move from discretionary subsidy like direction that the V model allows to something that's programmatic. You can make the argument that maybe younger protocols that makes more sense for it to be discretionary, to allow essentially actors with money at stake to direct things, because essentially they'd be incentivized most to grow the protocol. But it becomes a balancing act of maturity of protocol, depth of market, distribution of ownership. Crypto remains like the great economic playground where you can play with these incentive structures, and we can really fine tune things. I mean, the corporate world has a really good model with its principal agent setup, KPIs and all this kind of corporate talk that gives me a little bit of PTSD, but it does well to align activities with incentives, and I think we're just seeing the constant iteration here and honing in on what makes the most sense for crypto, for DeFi, and here it seems to be composable. And less gamification, the better. The more you can align to token holders, like I said, as long as if we're outside of the ownership meta, the better. And I think we're kind of moving in the right direction.
Well, maybe crypto will finally land on a model that actually looks a lot like the traditional financial markets. Oh wow! And
Just keep
that
on
brings us to our
reinventing
last
it.
story.
Proud.
The Securities and Exchange Commission last Wednesday put out guidance. This from the three main divisions of the staff of the Securities and Exchange Commission. So that's the corporation finance, trading and markets, and investment management. This is not too long a note, but a couple hundred, maybe like 800 words, 1,000 words. It explicitly creating a taxonomy for how they think about tokenized securities. And so I would say it doesn't really take a qualitative assessment of these different models, but it breaks them broadly into two models. Your tokenized securities, either issuer sponsored or it's third party sponsored, which I think is right. It either flows directly from the issuer of the security or it flows from someone else, right? It is created by somebody else. So just for context, GLXY, we tokenized our stock first on Solana, well, only on Solana today, but not necessarily always forever only on Solana, back in September. And that is an issuer-sponsored security. And there really aren't many of these. Exodus did it on Algorand in 2021. I don't actually know. I think Forward Industries has since done it, maybe SharpLink as well, but not many. Where GLXY, we are the issuer of our stock, and we made it possible for our stock to be available in token format. We didn't actually do an issuance. We didn't create new shares to do it. We made it possible for existing shareholders to transform their traditionally formatted shares into tokenized format. But that's an issuer sponsored. And then if you think about most of the other ones you see today in DeFi and on offshore exchanges, mostly like Ondo and Xstocks, these broadly fall into this third-party bucket, right? Like Xstocks isn't tokenizing its own stock, stock. They're effectively buying other stocks and putting them in individual fund structures and then tokenizing the shares of those funds and then giving you exposure, and letting you buy and sell those tokens that represent ownership in a fund that itself owns stocks, right? Ondo's setup is a little different, but still in a third-party sense, right? And so breaking those buckets up, I think, was really helpful and important. You can't really agree on moving forward on a complex topic until all the stakeholders use the same language. It's actually an important part of all of these crypto bills, the Genius Act, the Clarity Act, and any other complicated bill, right? There's always the top of the bill, the first section is always a bunch of definitions. And so I think this is really good helping the SEC or showing that the SEC has sort of formally come together and said, these are the categories, people. When you come to talk to us about this, make sure you can explain how you fit into one or the other of these categories. The only other thing I would say is I wrote about this, and I think there's pretty significant Ondo and Xstocks volume offshore and in some cases on chain, and there's virtually zero volume for issuer-sponsored securities today. But of course, issuer-sponsored securities, I think even the folks at the third-party issuance platforms would agree, ultimately is the way this should go. You don't need to buy a single asset ETF that owns Tesla stock to get exposure to Tesla. You can go out and buy the actual stock. And I think that's where the industry broadly wants it to go. But it's, more complicated, a lot more complicated from a regulatory standpoint. And so I was sort of just advocating, though, particularly in the case of some of these third-party wrapped ones, Americans and others are accessing these tokens on chain today. And unless the SEC can figure out how to let the issuer-sponsored tokenized securities genuinely compete with those offshore structures, they're going to end up with a market dominated by U.S. stocks issued in offshore structures that don't necessarily follow U.S. rules, but are nonetheless still available to Americans. And that can't be the outcome that the SEC wants. So I was sort of prodding the SEC to figure out how to let issuer-sponsored securities really work.
Yeah, and with the SPV model as well too. I mean, they're subsidizing those at the moment as well too. They're not passing through any of the legal structure costs that imagine in a steady state. 5 years down the line, you probably have to pay for your fund administration. That has to come from somewhere. So it's a
that's true. I mean, ETFs, other forms of funds charge fees. They charge fees. I mean, that's the thing, right? You could have an ironclad contract with an SPV that you feel very confident in. That's totally possible. It's not impossible. But that's the question. When you buy one of these third-party sponsored securities, to use the SEC's new terminology. Like you're not facing the issuer of the underlying security. You're facing some entity, and whether or not what rights they're conferring to you is determined between a contract between you and not you, the token holder, and them, the administrator.
They call those structures bankruptcy remote, not bankruptcy free, for a
we
reason.
just don't know. That's right. And again, I'm not passing judgment on any of those. So like I haven't reviewed each one of them to say that one's contract is good or bad. And by the way, the SEC does not either. That's sort of what I mean by saying it's not qualitative. But like, do you have all the same legal governance and economic rights as if you own the underlying security? Probably not, right? Because you don't own the underlying security. You own an interest in the underlying security. And that interest is set forth in a contract with a third party. So, it's not bad. Some of these aren't too bad either. But it doesn't feel like, they're explicitly not done under the SEC's remit. So the question is like, if the SEC wants to control and bring the same rights as the traditional stock market to these on-chain stocks, then they've got to make progress on that.
Who is Alex? Like besides obviously like issuers like ourselves and Ondo and X stocks, like is there also kind of like pressure coming from traditional like asset managers and issuers to kind of get clarity from the SEC because they want to start doing this type of stuff on chain?
Yeah, there's a lot of requests for clarity on the SEC's desk right now. I can assure you of that. So but unfortunately, by the way, as we record this on February 2nd, I think the government is shut down, right? Or it's about to be shut down, probably just for a day or two, it sounds like.
Just a little shutdown.
Just a small shutdown.
People don't, it seems so long ago in Bitcoin and crypto lifetime, but like there was a huge shutdown in the fall. I don't know if people forget that. Massive. Was it the longest ever?
It was like 40 plus days.
Yeah, I think it was the longest ever.
Way too often.
So anyway, there are a lot of such requests, Lucas. The other thing I think it's worth there are such requests of the SEC. The other thing worth mentioning is like there's two, I'd say, other big things that we've talked about in tokenization that aren't these third parties or the issuers. It's the exchanges. So NASDAQ and NYSE both have announced plans to allow tokenized stock trading. It's not clear that like they're saying they're going to tokenize the stocks themselves, or if they're just going to build a centralized venue where you can trade tokenized stocks. I think one that is materially possibly a third category, or it's a subset of the third party sponsored category, would be the DTCC's initiative. I think first they're saying with the Canton Network as their blockchain, but they received no action relief, which is sort of like guidance in a handshake deal. They won't be sued by the SEC for moving forward. It's sort of what we call exemptive relief or interpretive guidance to allow them to tokenize the underlying stocks that their members have custodied with them, but their members are like
90% of all stocks.
Yeah, but that's also like not the issuer. It's kind of like saying like if Fidelity uses DTCC, which they do, Fidelity could say, hey, Depository Trust and Clearing Corporation, we'd really like it if like 10% of the Apple stock you hold for our clients was held by you in tokenized form. Like to me, this is sort of a back office thing. It doesn't enable that I can tell like a end client of a broker dealer to then take the token out of DTC and put it in DeFi, for example, which is really the thing we're trying to, examine and investigate. So it's relevant, but it's not quite the same thing as what the SEC is describing here. But nonetheless, all of this, if we're going to enter a tokenized world, then like the whole loop has to be closed, right? Like you got to be able to do something. You got to be able to self-custody the token, possibly use it in DeFi. Just say, hey, I don't want to use it in DeFi anymore, and send it right back to your broker dealer. Broker dealer's got to say, oh, we don't want to custody this. Maybe we'll have the DTC custody this for us. Later, when someone trades it, they might want to trade it in tokenized form at the New York Stock Exchange or NASDAQ, right? You can imagine like it's all part of one sort of big project. I know sometimes they seem in conflict, but I think these are sort of all going to converge on a standard where, and with the right rulemaking and possibly legislation or administrative and interpretive guidances, you'll find that sort of like all the pieces eventually start to fit together in the way that the market wants, and that is, safe for consumers. Lot, this is one of the most exciting areas, I would say, in sort of like crypto and certainly in policy right now. It seems still a ways off, but you've never had more high level discussions by, market participants, the exchanges, the broker dealers, the asset managers, and regulators and legislators about this topic. So we're sort of at peak tokenized security. The question is like, are we like I don't think we're near the parabolic blow off top, though. There's actually a lot more to come on this.
Given all the bad vibes in crypto, I mean, this is we're close to an end around with the majority of the stocks being able to trade tokenized. Like it's quite the cognitive dissonance between that and the Bitcoin price.
Mm-hmm. Yeah, no, like we spoke about last week in the context of like the Davos stuff. It's like more of a question of like, okay, how do we do this and go experiment versus like thinking in like theories and like, oh, like this is how it could work if we were to do this. There's like actual like rubber hitting the road here. Even if like some of the existing models aren't end game, like we're at least starting to work through kind of the experimental phase in like a real way.
Yeah, and there are examples. I mean, of the categories they talk about in this note, though, there are live examples for them to work with, and I think that's crucial.
I mean, the big players have been getting ready. I mean, JP Morgan and a bunch of banks have been using Kinexys, I think is the name of it, as their interbank kind of settlement and like testing framework. They're ready to operate in a tokenized on-chain framework. I mean, you just get the go ahead with the rest of the infrastructure. I mean, we're ready to cook.
Yeah, you can see also too stable coins also becoming, like kind of essential for any kind of native on-chain commerce, as crypto has clearly shown. Like, what use is it to trade a stock in 24/7, almost instant atomic settlement if you can't also trade the denominator in the same way, right?
Yeah.
Like, so banks onboarding stable is also a huge part of this, I think.
I could tell you I'd be happy to be an IB interactive brokers client and true up my margin on my gold position with USDC intraday rather than wait 2 days for the wire on Friday.
Yeah, it's going to happen, and it is happening. So, but all right, before we wrap, gentlemen, what are you looking at for the week ahead? Lucas.
Yeah, I mean, so we talked a little about 8004. That's kind of like the tip of the iceberg, I would say, in terms of all of the AI innovation and activity that's been happening in crypto the past few weeks. And so I'm going to be writing a short note this week, kind of going through a few evolutions in terms of how AI and crypto have been intersecting relative to like the last blow off AI crypto top we saw, which I would say was end of 2024 or so. And more specifically about kind of why crypto has a role in AI, not just how they intersect.
I want to see Molt Book in the title of that report, Lucas. All right.
I'll be soliciting input from Molt Book for the piece.
Can you?
Yeah, we could try it.
All right, sick.
Oh, I'm looking at prediction markets here for the Super Bowl. I mean, sports betting it seemed to be one of the real matches for that, and we'll see kind of how it goes versus traditional books here with the Super Bowl. See kind of.
Oh, you're tracking like the discrepancies between odds and stuff. Like, is there an arbitrage?
Yeah. And if there are any big moves going on chain as well too, like are whales choosing to to go on chain in Polymarket versus do large size in the casinos?
I did see that Polymarket has just had to ban citizens from the state of Nevada pursuant to a temporary restraining order, obviously about litigation involving whether or not they can do sports betting.
Gaming commissions are strong.
Yeah, but I
think it's only like a week or a 12-day.
Yeah, I think it's like the court has like 2 weeks or something to decide on an actual block, if not, and so. But in the interim, though, they're ordered to block while the court decides, something like that. We're not lawyers, so if you have an interest in that, go look it up. But that was a news headline I saw related.
Yeah. But yeah, that and looking at some other the VE tokenomics projects and seeing if we can do some profitability analysis on their pool, see if the Pendle decision to move is something that's broadly applicable across other VE protocols.
All right, and Zach, what about you?
Yeah, I'm looking at a couple things. On the lending front, we are kind of working through getting our quarterly report done. One of the interesting things so far is CeFi lending has actually held up considerably well versus DeFi. Like we mentioned earlier, DeFi lending is down like 25% from the peak. Right now on the data we've collected on the CeFi side, it's mostly flat. And we're still waiting for some of the big ones like Tether, which has just had like monstrous quarters the last like at least 2 or 3 quarters in a row. So it'll be interesting to see where they come in at. And then on like the ownership coin ICM front, we have another fundraise for an ownership token this week, with one caveat that they're kind of changing the raise mechanism from going from this pro rata with like a raise cap allocation to no cap with like some buy wall setups to see maybe we could reduce the massive like competition that comes into these raises at the end as everybody fights for a pro rata share. But yeah, we'll see what happens. That'll last about 4 or 5 days this week.
All right. Well, and I'm looking at one of the ETF flows. I think Thaddeus mentioned that this morning on February 2nd, Monday, that Bitcoin ETFs are trading at a premium that suggests a significant demand possibly to buy the dip. The question is how significant, because like we even 2 weeks ago we were at 98K briefly on Bitcoin. Now we're at 78K. Right? Like, is it looking strong enough? Is the market going to come out and buy in a way that looks like a bottom is forming and not that sort of just some volatility as part of a downward trend? And maybe we'll get some info from the ETF flows on that. I'd say that's probably my core thing here. That and the government shutdown is what if I'm told by smart people that it's going to be like 1 or 2 days? What if it's not, right? Like, they have huge impacts on markets. We don't quite know. We're talking about the U.S. Congress here. Like, are they going to get together? I'm told seems like they got a deal, but look how thin the margins are in the House, right? Like, who knows what happens there. So also watching Washington to, our incredibly efficient 3 branches of government can get it done. Keep in mind, we're also still waiting, I think, for some key Supreme Court rulings like on tariffs, which we have not gotten the president's authority to use his tariff power. So going to be watching Bitcoin and Washington. No surprise there, I think, for people who followed me for a while. Well, that's it, gentlemen. Thank you so much. Zach Pokorny, Thaddeus Pinikavich, and Lucas Chayan from GLXY Research. Everyone have a safe and happy week. We will see you next week.